Okay, good morning, everybody. Welcome to our panel. We're going to be talking about the change that's going to hit the banking sector over the next couple of years. My name is Jumana Versace. I am a Bloomberg television anchor. Really delighted to be moderating this panel today. And we are going to be talking about some of the mega trends that the financial sector is going to be sort of contending with over the course of the next few years, but also over the medium term, long term. We're going to be talking about some of the macro drivers, geopolitics, sustainability, technological advances, and of course, we're going to talk about regulation as well. A few things have happened in the last 24 hours, so we might touch on that as well. Just a couple of housekeeping points. If you want to tweet about the session or whichever social media platform you're on, you can write about it with the hashtag WEF25. And then if we have time, and I'm conscious that there are a lot of panelists today, I may open up for a couple of questions. So without further ado, let me just introduce our panelists. So Mary, I'm actually going to start with you, namely because JP Morgan posted record profits for the year last year, and we really saw a lot of momentum kick in the fourth quarter. There's a perception that things are going to look up for the sector this year, be it on deal making, be it on a lighter touch regulation. Do you expect these tailwinds to continue going into 2025?
Yes, well, I think we're all very excited to be here to kick off Davos 2025. And I think animal spirits are alive, as Stan Druckenmiller said yesterday. We have a world that is changing quickly, as seen by the last several hours of the new administration. And I think all of it is hopefully going to manifest itself in the US economy and economies around the world. And so we're very hopeful that we do get a lighter touch regulatory environment. Regulations, as we know, are very important for almost every industry in the world, but in banking, it's particularly stifling, particularly when it comes to lending and keeping the global economies going. And so if you look at the last administration and the number of new significant regulations, it's 8 times the number of significant new regulations versus the prior Trump administration. And so with that comes multiple millions of man-hours of paperwork and other things that clog up the system and stop the economy from continuing to have that very healthy flywheel. So we're really looking forward to that. It also manifests itself in the ability for people to invest in the great companies that want to come and take themselves public. If you just look at what's happened over the last several decades, 30 years ago, we had 7,300 public companies. Today, we have 4,300. Mm-hmm. But 20 years ago, we had 1,900 private companies, and today we have 11,000. And so what's that telling you? It's telling you the companies don't want to go public or can't go public because of the heavy regulatory burden. And hopefully you'll see that be able to enable the general public all around the world to invest in the great companies that are taking themselves out.
Just to add to that point, just on the slowdown in M&A activity, is it just because of regulatory headwinds or also the interest rate environment? Because we've also been in a high interest rate environment as well.
Yeah, well, I think interest rates are fairly moderate given the environment that we're in. They're not overly restrictive, and I think that all of it will come together, hopefully in a way that will fuel the economy. And I think all of us will participate in that. And you're going to see it in everybody's earnings. And I think that it's just the beginning of really go mode here. And I think we're very excited about it.
Okay, of course.
Yeah, sometimes when we are up here every year talking about banks and bank regulations, it sounds very self-serving. But if you just think about almost every scenario where you need regulations in government and public and private sector to come together, as His Excellency was saying. And you just look at some of the issues that we've been having most recently on the energy front, and California is a perfect example of that, where you have the best intentions of regulations to try to control burn in California or to try and figure out the safety and security of water. And then you result in California fires because you haven't done controlled burn, you haven't had a reservoir built since 1979, you don't have the fabric and materials to build fireproof housing, and you end up with the disaster that we've had. And the same thing is being talked about overnight about Germany and the fabulous success that Europe has had on the the move to electrify, most of that they've done with renewables. 50% of what is done on the manufacturing sector in Europe is done with renewables. But the problem is now Europe has 5 times the cost of manufacturing that some of these other countries, particularly China and India, but even twice as much as US. And so you say to yourself, no wonder Germany has now found itself last night on the bottom of the list of the 30 countries with GDP growth forecasts